Welcome to Money Hangout. This is a weekly interaction with our readers, visitors to our website to help you discuss and understand personal finance and investment issues. This is brought to you by Birla Sun Life and Value Research. The whole effort is to help you understand things which become so noisy, and the last week has been a very noisy time. Demonetization happened. In fact, we were supposed to talk about why the risk of investing in equity, and last time we postponed it for a week because the demonetization happened, and we were so enamored by the basic questions or anxiety of all the readers or visitors to the website that we thought of talking about it this week, and that is what we are doing now. And what a week it has been. Market is on a free fall. uh, all the things that worked till about a week ago has stopped working. There is a whole new dynamics. Everybody is thinking now in terms of which sectors will do well post demonetization, which sectors will be hurt most, and what happens to my houses, what happens to my personal finance, what happens to my personal investment. And I think it is about time. It's just the right time to understand or talk about risks of equity investing in equity, because when the market is going up steadily over time and has been going up, it is very difficult to talk. You may not be as receptive to talking about risk, but risk just visited us. We understand risk very well in a week when the market is down about 5-7%, and our personal investments are down about 10 to 14%. If we are invested in the performing funds, the fund which did very well in recent past, they will be down 14-15%, which might be very disappointing. So from that standpoint, uh, it's important for you to understand why equity works, why it is so volatile, and what you should be doing uh, uh, to really deal with it. uh, because why equity turns out to be the best performing asset class, simply because whenever you buy equity or an equity fund, buying an equity fund means that you entrust your money to a fund manager who is responsible for investing that money in a set of companies. So you indirectly become the owner of those companies in a proportionate way. So the reason why equity works is you are the owner, and owner always makes more money than it must be profitable for him if he's borrowing money. If I set up a business, I will borrow money only when I will be able to more return for myself. By borrowing that money, I can actually it will the leverage, the borrowing will enhance my return, which means the return on my equity will get will multiply, or will get magnified. The leverage might help. So that's one thing. The other reason why equity does well over time is all the products and services provided by companies in the economy. They get adjusted to they get adjusted with the inflation. I was buying something for 100 rupees. If my input costs go up, then I revise my price. Otherwise, and if I'm not competitive enough, I get phased out of the business. Uh, then this in itself, a company which gets bigger over time, if a company is able to revise the prices because it produces a high quality or a reasonable quality product, or delivers a reasonable quality service, and customers value it, then it gets bigger over time, and it actually marginalizes the smaller guys. This is basic capitalism at work. And uh, and also, equity must beat fixed income, because otherwise owners won't borrow. So that is the basic reason, that is the key point which an investor should take note of, that why equity beats inflation and why equity beats fixed income over a period of time. There's the economic logic to it. Otherwise, businesses will come to a standstill. We can't reverse it in a prolonged period for a prolonged period for the basic economics to work. Then comes, why equity gets so noisy. You buy a great company and goes up over time. It it gets bigger over time. It becomes more profitable, or it sometimes it gets phased over time. But all of these things don't, nothing much changes on a day-to-day basis. But the market is a very noisy place. A lot of things are happening globally. domestically in a specific sector by the government, by the investors. And in the environment, we hear a lot of noise. Sometimes it is a monsoon, sometimes it is a budget, sometimes it is the government or action. Of course, the government actions over time, and sometimes it could be the investors' behavior. Sometimes it is the FIIs, investors from in foreign countries, what their attitude will be, yeah, because they are allocating assets globally, and their preference for India has a big impact. Their lack of preference for India, or their disinterest in India, can have a big impact, because they are now a very sizable, or they are very impactful set of investors for India. So there are just too many things happening, and trying to make sense of noise is very difficult. I'm not saying it is wasteful, it is useless, but you can't do much about it. I think equity investing at a certain stage is, to be successful with this, it is very important to really filter the noise, avoid the nonsense. This is crucial, because if you just listen to each and everything, we are living in a very noisy, connected world. There is too much of media, too much of opinion, and if you listen to each of it, it will be very difficult to absorb, filter, and make sense of it. You will end up doing nothing, or you will end up be out of it, or you will end up being in a very confused state of mind, which will lead to inaction. Uh, Economic event, you have to really think in terms of diversifying. You have few things in your hand, which will help you filter this. Uh, then comes, the market has become a gambling den. The proliferation of derivatives, the amount of, and more so in India, because all other forms of speculation is banned in this country. It is illegal. So, people are able to vent out. Of course, derivatives were created to actually de-risk the market, or, help people hedge their risks. And some people, a small, tiny minority, will be doing that. But majority of the domestic investors, they actually are attracted to the market because they can speculate, and speculate with a small sum of money, and they can do big trades. It is almost like a leverage trade. You put 10% of your money, and you are able to carry 100 rupee worth of transaction. Little movement, and your money disappears, vaporizes. Because if you put 10 rupee, and if you take a position of 100 rupee, if the market goes up by even 10%, your 110 rupee becomes 110. As effectively, it means that your return on investment is 100%, because you are leveraged. That is what derivatives do. But the flip side of this is that if you have 10 rupee and you take a position on a 100 rupee thing, a 10% decline of the kind that we saw in the past week will lead to your bankruptcy, because your 100 rupee becoming 90 and your 10 rupee is gone. And this is what is happening. That is what drives all this hyper activity, lot of anxiety, investors going crazy when there is a sharp movement in the market. But you are not one of those kind. You have to really think in terms of how to benefit from equity, at the same time how to keep away from the pitfalls of equity. How should you deal with this? I think this is the very crucial aspect. You don't have a control on the noise. You don't have a control on the even the future outlook of a company. A great company can turn bad, and that is actually a very fundamental risk of equity investing. That is something which you have to deal with and configure yourself so that you are able to deal with it effectively. Good companies turning bad, the way to deal with it is diversify. If you are buying shares yourself directly, buy quite a few of them. I think 15 to 20 stocks at the least should help you protect from a great company turning bad, because companies turn bad for a variety of reasons. It could be environment, it could be obsolescence, it could be change in management, it could be a variety of things, and all the risk cannot be visualized. So de-risking yourself with diversification is critical. The other thing is the timing risk. Investors get excited in a fairly seasonal way. Uh, Last year, investors got very excited and they started putting money. It's extremely important to have a plan. Stagger your investment. If you do not reduce the market risk, because market itself is very noisy. Eliminating the risk of possibility of catching a market high is very important for all small individual investors. because if you don't do that, you will get derailed. And if you are caught on the wrong foot ever, if you invest 5 lakh rupee, if you invested 5 lakh rupee even 10 days back, and if you see your 5 lakh rupee turning into 4.5 lakh rupees or 4 lakh rupees very quickly in a span of 20 days, you will keep waiting. You have turned into a non-investor now. You will stop investing. That's one. The other is you will keep waiting for your 4 lakh rupees to turn into 5 again, to get out of the market and never to come back again. And you will be deprived of the great ownership opportunity which equity provides. So it's important to eliminate the possibility of catching a market high. Stagger your investment. Then comes, how should you? Third most important thing is uh, working on the basic asset allocation. All investors can't buy equity or can't withstand even a diversified portfolio, because when it falls in a manner which we start relating it with our income, we start relating it with our real lives. Uh, if you have 10 lakh rupees and it goes down in value by 50,000 rupees in a month, a week's time, then you start thinking in terms of, this was my monthly salary or this was my 2 month salary. That creates a lot of it. You have a stomach ache. It's extremely difficult to hold that emotion. You have to really get over this. uh, the only way to deal with it is stagger your investment and get into the right asset allocation. An all equity portfolio may not be suited, or may not, most investors can't really seamlessly withstand the shocks of equity which our markets provide, and markets are going to remain like this. Markets have been volatile, they will remain so. And if you can't withstand that volatility, you have to factor in at the outset. Think of a balanced fund, which is 70% equity, 30% debt, which provides you the stability to your portfolio. It is a reasonably equity portfolio, at the same time less volatile by its complexion. Even that will turn out to be more very volatile for many people. Then consider a 50-50% allocation. Put half of your money in equity fund and half of your money in fixed income fund. That is how you have created a balanced portfolio. And then periodic rebalancing. If you follow the principle of rebalancing your portfolio when your portfolio goes wacky, if you have decided on a 50-50% allocation, equity does well, and if it changes by 10%, you move your money from equity to fixed income. If equity does poorly, you move your money from fixed income to equity. This is the way you are able to change your allocation, and you are better geared to withstand any dramatic shock which the market is bound to provide in all times to come. Then, uh, and the most crucial thing which most investors should be the starting point, that the money that you don't, the money that should be invested in equity is the money which you don't need in the foreseeable future. And the foreseeable future time frame, I would say, that is 5 years and more. If the money that you need in next week should be in a liquid fund, or should be in your bank account, or should be in cash in small denomination currency, uh, that apart, the money that you need in 3 to 6 months, 1 year's time, should be in a short-term fund, should be in a fixed income fund that is reasonably safe, that is a very stable asset class. They never go down in value. The money that which you don't want to, you want to be absolutely risk free, that money should be in deposits, that money should be in top rated bonds, or that money should be in top rated income funds. Income funds, they could be profitable for now. So once you have worked this out, and these are things which you can control. You very well know the money that you are unlikely to need for next 5 years. You very well know the money that you are likely to need in next week, next month, and the money that you are likely to need sometime after 5 years should only find its way into equity, because that should be the starting point. Because any kind of risk tolerance that you claim to be, if you need the money in 6 months time and you see the market crumbling, it is impossible for you to hold your emotions. You will get distracted, you will be anxious, you will panic, and you will worry. And that is a huge distraction. That is something which will derail you from an investment plan, a long-term investment plan, which will help you ensure, protect your long-term financial well-being. So if you have these 5 variables in place, allocate your long-term money to equity. Don't allocate your long-term money, short-term money ever to equity. That's one. choose the right asset allocation, have the essential component of fixed income to provide to create the shock absorber in your portfolio, because most investors like the upside, they don't like the downside. So it's important to work on that asset allocation before you start. And maybe most starting investors will do well with a balanced fund that will something like Birla Sun Life 95, or HDFC balanced, or things like that. And so they don't crumble when markets fall freely. Third is be regular, never invest lump sum, where large amount of money if you're in the initial phase. Once you are done with, once you have been an investor for 4 or 5 years, then I don't think that, and that money is going to be invested for 10, 15 years. Lump sum is not a problem, but investing lump sum money, a large amount of money at the outset, becomes a big psychological blow, and that derails you. So if you do these three, four things, investing regularly, in diversifying, choosing the right asset allocation, and the starting point, taking care of it, you will be fine. In fact, the market fall of the kind that we have seen, I think it's a great opportunity, because markets will suffer in the short run. It is completely unknown, because we have never experienced what has happened in the past, or what has happened with demonetization, and markets are falling. A lot of companies are, the more expensive company, richly valued companies are falling more rapidly. This will create opportunity in the market. But if you stick to these rules, invest regularly, don't get carried by it, don't invest at one go. So follow these rules, and I think a lot more money is made by investing in lean times than in roaring times of the market. So all the best, get started, follow these rules, and you'll be able to mitigate the risk of equity far more effectively.